Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by managing director and investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well. How are things going for you?
Yeah, all good, all good. A lot of things to touch on today. I know you tend to take a 30,000 foot view of the market, so we'll jump around a bit. Let's start with earnings. We're in the middle of an earnings season, but I think we have enough to kind of get a sense of things. How are you seeing earnings and any big takeaways so far?
Yeah, absolutely. So obviously I'd say we're a little more than halfway through the earnings season now. This is the second week of we're approaching the end of the second week of the two busiest weeks of the earnings season. And overall, earnings are holding up from my perspective. We have it looks like the first quarter growth rate is going to be about 5.5%, which is better than what the April 1st estimate was overall for the overall index. I will note that there was a pretty large write down within the healthcare sector that's actually dragging the overall index earnings growth rate down. And if you exclude that one-time charge, the growth rate would actually be closer to 9%. So, all things considered, earnings growth is looking pretty strong. When you look at the annual EPS numbers for both 2024 and 2025, they're reflecting an 11% growth rate for the full year and a 14% growth rate for next year. So we continue to see things as in the positive light. One other thing I will note is that when you look at, there's been a narrative that the Magnificent Seven has driven a lot of the earnings growth. And if you look at kind of later this year, well, that's been true. If you look at later this year, that actually begins to change a little bit, and the growth rates actually of the Magnificent Seven and the remaining 493 actually begin to converge. And so, from my perspective, that's actually looks like a pretty positive sign, and that actually suggests to me that earnings will be broadening out as the year progresses.
Right, and that would match what we've seen in the market, which is a broadening in a couple other sectors take the baton of leadership. And I think overall, good to see earnings kind of filling in, or at least holding up there into the bargain when valuations have gotten quite expensive here. So all good on that front. Let's shift a little bit. The market has been a bit wobbly lately, a trickier April after a really strong start to the year. How are you thinking about the overall volatility picture for the market today? And what are the vol stats actually telling you?
Yeah, certainly. So, it's been a little, I'd say it's been about 300 days since we've actually had a 2% down day. So overall, we've actually seen a pretty stable market environment despite the uptick that we've seen recently. That's the longest stretch since 2017. And so it's been quite some time that we've really had to be concerned about it. At the end of the day, when volatility is muted like it is today, it actually is good for equity returns. You tend to see stronger equity market returns during low volatility periods compared to those with higher volatility. So overall, I'm not really too concerned about the low vol. I know a lot of our clients want to constantly think about the coming event that may actually increase volatility. But if you're constantly worried about the increase in volatility, you could miss out on the longer term returns that the market actually will offer you.
Yeah, I think that's a really good way to think about it. We're always looking for that next thing around the corner, but obviously the last 4 months last 6 months really have been great to be invested in kind of a low vol environment. All right, ending here, the inflation and interest rates are still two of the major macro drivers of the market. We're actually recording today on a Wednesday. It's a Fed meeting day, so grain of salt here, but I think there are still some big picture takeaways from how the inflation picture has shifted and thus how the interest rate and Fed picture has shifted over the last several months. What's your latest there? Any big takeaways on the Fed front?
Yeah, I would say overall, obviously, the number of rate cuts has been priced out, for this year, and we're continuing to see that. But I think that the bar for an additional rate hike is extremely high at this point. A lot of the higher for longer is likely, starting to have its impacts on the economy. I wouldn't say anything that's overall detrimental, but at the end of the day, the longer that the Fed is on pause, historically, the better it has been for equity market returns. The longest pause on record is actually going back to 2006 and 2007, and during that period, the S&P was up 22%. So We've obviously had a good run here since the Fed has been on pause, and you don't have to really. I wouldn't be too concerned about an additional pause here. There was a narrative for some time about how the equity market needed cuts to actually continue to move higher, but I think some of those fears have been removed, just given how resilient that the U.S. consumer has remained and how strong economic growth has been.
Yeah, I think it's a really good point. Obviously, the narrative is that the market needs rate cuts to survive, but typically throughout history, the Fed is only cutting rates when bad stuff happens. So if they feel like they can stay on pause, obviously it's led to good returns historically. So that's a really good note. Ryan, this has been really insightful. I appreciate your time as always, and hopefully we'll get to talk to you again soon.
Absolutely, Ross. This is great. Have a good one.